So the first slide goes as financial sector risk management. And today we are starting, I think, new module in your postgraduate diploma in bank management. This one is called risk management, especially since most of you all are attached to financial institutions. I renamed the topic to read as financial sector risk management, because risk management is a very vast subject. If you talk about it in other businesses also, they manage risk. Therefore, I termed it as financial sector risk management. Are there anyone who is not attached to a financial institution? You can speak, you can unmute your mic and speak if anyone is not in the financial sector. Okay, with that I believe everybody is either they are working in a bank or a financial related business. So I will move on. The first slide, what it says is ships in the harbor are safe. But that's not what ships are built for. So in other words, what we say is, in business, if you don't take risk, the profits won't accrue. So any kind of business, even in financial sector, if you don't take risk, your returns are going to be lower or none. So what we do in all our aspects of our related work, we take risk. So this is a very important subject because it affects whatever department you work. Is there a certain amount of risk in that? And how do you manage that risk will depending on the bank's profitability. So ships in the harbor are safe. It is like, you only give credit to people who have placed fixed deposits. So you can, if they are not paying back, you can withdraw their fixed deposits and set off against that. So that is not what the banks are for. Banks are to maximize profit, to pay for their employees, pay for their all other stakeholders, including shareholders. So this is what I say, ships in the harbor are not safe, are safe, but it is not what the ships are built for. Similarly, banks are not only to take deposits and then lend against that, then our profits are going to be lower, and that particular margin what we enjoy against that will not be sufficient even to maintain our buildings and pay for your salaries. So banks generally take more risk than, rather than give advances against the deposits. So first I will go on the definition. Today what we are going to talk about is some introduction to the subject. And I have, I think Mr. Bankers have sent you 3 sets of PDF forms for next 3 lectures. Also, they have sent you in their email, I saw they have listed out the 12 sections what we are going to cover in this particular subject. The syllabus includes 12 sections. In that, the first section is the introduction. So today we are dealing with the introduction. And as I said, financial sector risk management. So let me explain to you what is financial sector, and then what is risk and what is management. I think, of course, management I don't have to explain to you. Rest of the subjects what we have covered is all related to management. So financial sector includes, I have to start with the central bank, because they are our godfathers and the regulator. So they also part and parcel of the financial institutions. So with that, their support and guidance, rest of the financial sector get regulated and perform to achieve the objectives of the country, that is financial stability, and economic growth. So we have to mention the central bank roles here. And then you also have banks. Banks also, you will get development banks, you get licensed commercial banks. So there are different types also, but generally, when you say a commercial bank is geared to, operate as a major player in the financial sector. Then you will have finance companies. You know what are they? And in Sri Lanka, there are many banks. We have about 26, finance companies about 52. On top of that, we also have leasing companies. Then we also have these primary dealers. Primary dealers are sort of financial institutions which they have a treasury, and with that they do investments, and those investments also involve certain amount of risk. Then we have money brokers who actually deal in bonds, and also they also kind of arrange large scale money supply chain. Then we have securities firms, insurance companies, pension funds, unit trust, venture capitalists, and microfinance institutions. All these are in the financial sector, and all are taking financial risk if they have to make money. So I will move on to the next slide to give you what is the definition or the meaning of risk. Now, if we are in person, I could have asked a lot of questions, because especially when you're operating online kind of teaching, it's difficult to interact. But however, if you have any questions, I want you to, either unmute your mic and speak, or at the same time, you also can send me a note so that during the interval, I will go through all those notes, and then I'll find some answers to that. So, but we talk about risk. To give a definition to risk are many types. Actually, somebody asked you, what is the risk you are running when you selected to do this particular postgraduate diploma? I wonder you will answer saying that you have invested a certain amount of money, and if you have not achieved the objectives, like if you have not passed the examination and get that certification, you will not run the risk, because you will lose the money what you invested. I know some of the banks will reimburse once you pass only. So to achieve that objective, you take a risk. And the risk is that you go through all this entire course, and then you sit for examination, and you make sure that you achieve your objectives. Then during that time, there's a certain amount of uncertainty. Now, yeah, that uncertainty is what you call the risk. Now, similarly, banks accept deposits, and part of that they lend. And when you give credit to your borrowers, not all of them are going to repay. So bank also run the risk by trying to achieve objective of higher profits. So we also can think of in the other way. The risk will result in either positive or negative, give positive or negative results. Now say if you have done your exam well after studying well, and if you have done the exam well, what is the result? Result is that you will get passed. So we call it a positive achievement. Similarly, if you fail, it is a negative achievement. Similarly, banks, when they do investments, when they do lending, either the result could be a positive. That means they will recover their interest, they will recover their capital, and recover in time. So with that, they will achieve the required margins, and as a result, bank will have achieved profit. But if one or two customers fail to pay, and if we had to transfer those facilities to non-performing and then prolong for a long period for recovery, and finally if we have to write off certain amount of capital or interest, then that result is a negative result. So when you take risk in a in order to achieve positive results, but along the way there are certain things which will affect your objectives and then could result in negative aspects of your objectives. Risk is why we need to manage the risk, is to always achieve positive results. So I also mentioned here the businesses cannot be conducted without taking risk. That's like the ship that is being built is kept in the harbor without sailing. It is like businesses who doesn't take risk and may not be able to achieve profits. So risk is uncertainty. Risk is not achieving positive results what you expect. There are so many definitions what you can do it. I gave just two examples of which is related to financial sector, because there are so many uncertainties could occur when we are in business, and those uncertainties either will result in positive or negative aspects in our objectives. As a result, we could either have a loss or profit. So when you have a loss, we say you are subject to risk. So we'll move on. I want to take a few for you to understand how this particular risk management came into being, because this is somewhat which will happen in the 21st century, because previously actually even banks, we never had this subject called risk management in banks. All what we do is we have our checks and balances. If you do things right, and when you do the checks and balances, and if everything is right, you will end up in profit. But in 2001, there was a very multinational company in the USA. Its name is Enron, and this company ran into problem after doing very well for a smaller period of time, for about 3 years. It became one of the Fortune 500 companies, and people who have invested large amount of monies have been invested in this company in shares and debentures and various other financial instruments. And when this company went down, there were so many losses to individuals, institutions, and so many, and it became a debacle in USA. And they thought the reason is that this particular company has not managed its risk properly. So the subject of risk management came into being with this particular company going bad. And this company is mainly are the people who introduce instrument called derivatives. I think you may have heard of this word. Derivatives are, kind of instruments, financial instruments you use to make payments on a future date. So it's kind of a gamble, like one of the very simplest derivatives I could say is forward contract. Now, if you have done your banking, if you're in the international department, a lot of people who open LCs will come and ask whether they could enter into a forward contract with the bank. That means, for example, we'll say a person who wants to import amount of we'll say US 100,000, and today's rate we'll say 203. So he knows that his amount will be 100,000 into 203 once the LC or the goods have been reached in Colombo, and then when he has to retire the bill. But it will take time for the goods to come. Sometimes the goods needs to be manufactured overseas, and your LC duration will allow, sometimes it will allow even up to 180 days. So during this time, exchange rate is not going to remain as 203 forever. So with this current climate, things are fluctuating so rapidly, and therefore this particular importer wants to make sure, he wants to know for good that how much he will have to pay. Based on that only he could be able to arrange the price of the goods when he planned to sell once it is been imported and cleared from the harbor. So he will come to the bank and say, in order to make sure that how much I may have to pay to retire this bill, could you tell me a rate in which I could retire the bill? So we'll say the bill is going to take 3 months. So the bank, what he's asking is a 3 months forward contract for US dollars 100,000. So bank will look at today's rate, and they will have certain calculations and predictions based on how fluctuations are taking place in the exchange market, and probably they might say within 3 months you may have to pay 205 or 210. So then they will sign a kind of a contract. Bank will say that whatever the rate is going to prevail at the time of retirement, you have to pay only 210 rupees for each US dollar what you have imported. So this might go even 215, still the customer is going to pay 210. This might remain even 203 at that time also, but as per the contract, customer is going to pay 210. In that case, bank will make profit. If I said if it goes higher than the value what you have already been contracted, bank will make a loss. So that kind of instruments are called derivatives. So I gave a very simple derivative instruments. There are so many derivative instruments which we will talk about at a later when we go on. So these derivatives are actually mostly a kind of future contracts. So this particular company they are dealing in oil. So oil prices also fluctuate these days, and I think if you listen to news these days, they are always talking about a price hike in the recent in near future. So because the oil price in the world market fluctuates, so this particular company, what they have done is they have opened shell companies. They have been branch offices in various parts of the world, and those who wants to import oil, they get into a contract with them, probably with the governments, and they quote a futures price for the exchange, or the kind of how much it's going to cost them a barrel of oil. So now we'll say about 3 months ago, barrel of oil is about $62. Nowadays, it's trading around about 85. So 3 months before, if Enron or any other company knew it's going to go up to 85, they will always, if they have to supply oil to a company, they will always quote a price above 85. So if they have quoted 85 and above, they will make money. If they have quoted less, they will have to supply at that lower price to the company whom they contract with. So this is what the Enron company did. So while doing this, they ran into a lot of losses in their shell companies. That means if they have opened a branch in Colombo, and if they have agreed with our petroleum corporation to supply oil 3 months ago at 70 rupees. Now the current price is 85. So still with that contract, they have to supply at 70. They have to buy at 85 and supply at 70. So there's a 15 rupee loss for them on each barrel. So if they have contract for 1 million barrels, so they will run into 15 million loss. Similarly, Enron's branches, or they call it cell companies, all over, they did contracts like this, and then they ran into losses. But what the company did was, they somehow, these losses, they didn't show in their books. What they did was, they called them receivables, or we call it debtors, and they arrange the books in such a way that the loss will be recovered at a later date. So with that, they still start operating. They're having huge losses in their companies, but they didn't show it on their financial statements. So this went on for a little while, and then the investors nowadays are also very they are savvy with the accounting procedures, so they will, when the debt is prolonged for more than 30 or 60 or 90 days, the investors and the analysts will question whether the debt is recoverable. In banks also, when we lend money, if the customers are not paying, we have to downgrade those accounts. Similarly, those debts of these shell companies had to be downgraded, and it was revealed that those are non-recoverable losses, and therefore they have to take it out from their profits. At this particular time, the company's shares were trading something like $90 per share. You won't believe it fell to a price of unbelievable of 70 cents. And with that, completely the share market was crashed. And then the regulators get into act. People had losses. They filed action against the companies. They asked now who's regulating these companies. If it is a bank, they can go to central bank, but probably this particular company would have been registered under Companies Act and managed by the company registrar. So they have filed action against all these authorities. And finally, the case went on, and they also found the chief executive officer of the company, his name is Anderson, he's also at fault. And also they found the auditors. Auditors are actually Anderson and company. I can't remember the name of the chief executive officer. The Arthur Anderson is the company which did the accounting, the leading accounting firm which did the auditing of this particular company. So when the case was heard, they also find that the auditors also have not looked into this. As a result, they are also responsible for the downfall of Enron, and as a result, shareholders lost the money. So with that, we got the nice term called accountants, which they generally use this. Accountants can cook the books. So instead of showing losses, what they have done is they are shown as receivables, and as a result, the investors got they didn't have the proper picture of the company, and they still started investing on this. And people who bought shares at $90 finally had to sell at 70 cents. As a result, so many millions of money has been lost in the share market due to the downfall of this particular company. Finally, it came to a point saying that the reason is this particular company didn't manage its risk well. As a result, all the stakeholders has to suffer. Now, I will move on to another example related to banking. If you have read a book called Rogue Trader, you will understand this. There's a book called a nice book called Rogue Trader, and name of the rogue trader is Nick Lees, and the bank he works is called a Bearing Bank. Bearings Bank. Bearings Bank is a 125 years old bank in UK. So Nick Leeson is one of the executives who were attached to the London office at that time. He was a real go-getter in their treasury, and all the deals what he took with money markets and exchange deals and all these derivatives what they trading created huge profit for Bearing Bank. And then what they thought was they had a branch office in Singapore, and they transferred this particular executive as the chief executive officer of the Singapore office. There again, he went and started doing the same. He took huge risk in investment in various financial instruments. He started investing money in Japanese bonds, and at that particular time, then he did the similar thing what Enron company did. He also concealed, or he also hid all the losses what we made from their investments, and as a result, it came to a point the losses were very much higher than the capital of this particular bank. If you had to write off more than the shareholders' value and the reserves what you have in your bank, there's no bank, because risk belongs to your customers, and even the loans are fully recovered, your deposits has to be paid. So they declared Bearings Bank as bankrupt. The bank, which has been operating for 125 days, so 25 years, went down just because of act of a high risk taking executive of the bank. And so this is one of the better examples of financial sector risk event which took place, and as a result, you have a nice book being printed. It is called Rogue Trader, and if you happen to get that, you can read the entire story. So risk management came into being with these type of examples, the past events which result in huge losses for investors as well as companies. Going forward, I also must say the risk also can be categorized into 3 different categories. One is a preventable risk. Generally, bank, I told you earlier, we said we were doing checks and balances before the risk management came into being. What we are doing is, we always see that our people get trained in the bank. They are conversant with the job what they do, and they follow the systems in the bank. That means they follow the all laid down rules, and there is always a process to do transactions, and these transactions are done according to the law and based on those processes. And once it is done, if your internal auditors can check and say, okay, if these things has done properly, as a result, we will not have any risk in what are the transactions what they have take place. So these internal events I also mentioned here, which is called, generally we call it a fraud, and those frauds also could amount to kind of risk, will result in losses. So these can be prevented. People can be trained, systems can be upgraded, your processes can be re-engineered, your internal frauds can be avoided with good controls. These are things what we generally do in the bank, and with that we can, whatever the type risk arising from operations can be prevented. But there are other things in bank, not only the operations. So those things may result in risk. Another aspect of risk category is a strategy. Now, bank can think of different strategies. I take example credit. They can think, okay, we are a bank. We don't want to deal with mass, large customer base. We want to only deal with corporate clients. And what will happen if a country has a situation of this nature? If all the corporates in the categories like tourism, transport will have to be downgraded this time. So the risk is not spread. This kind of when you deal only with one type of credit lines, you are concentrating your risk into one aspect. That is because of your strategy. Banks, we generally don't do that. We will have a corporate banking unit. We have some SMI unit. We sometimes have a micro unit. Then we have personal banking units. What we have done is strategically, we have spread the risk. So at one go, we will not have a huge loss. Similarly, market risk, we will not invest only in share market. We will also can invest in gold. We also can invest in treasury bonds, bills. So what we do is we spread the risk. That is our strategy. So with strategy, also you can minimize your risk. But apart from these two events which I talk about is the internal categories. The external categories also sometimes are beyond your thinking. So now we have a disaster situation. We have a huge external category event, as robbed the banks. Like COVID-19 is some kind of external event which has occurred to not only to banks, it has affected all the businesses. When other businesses affected, we may have to reschedule credit moratoriums for all of your customers. So this kind of external events could happen. It could happen through political instability. It can happen microeconomic changes. Now say we have macroeconomic changes. We have our GDP is on the minus. So what happened then? Things are not moving well. Prices will go up. Still, what will happen is you will have your high NPA in the bank. What we do is there are external events, like external frauds, hacking of your system by hackers in your computer system. These external risk also when there we have to face. And what we generally do is we generally we transfer the risk. We take an insurance cover. What we do is now say you transport cash to your ATM. Then what you do is you insure that cash with cash in transit policy. When cash in transit policy, if on the way something happens to this truck which is carrying your cash, you could claim your insurance. So generally these external events we cover by a transfer of risk, like to an insurance company, like theft, burglary, fire, floods. All those are things in the environment we operate. It could happen. So I have done two categories: the preventable risk, where your operations are concerned. Strategic risk is your thinking about your businesses. That means how do you plan your businesses to conduct strategically? Then you can minimize your risk. External events also you can minimize your risk by transfer of risk. So these are the larger scale categories of risk. There's something called risk universe or a framework, which this is applicable to mainly for a bank, and so I have put them on the slide. We operate in an environment, I told you when we discussed about the financial sector, I said 26 banks. They are all competitors. Now, if you are attached to one bank, rest of the 25 banks are all competing with you for your deposits, your advances, sometimes even with your staff. They will compete and take the best out of them. So, this is the environment you operate. You face the competition not only from banks, finance companies, leasing companies. Your deposits are being grabbed by various other institutions. Even now, insurance companies, they have their investment schemes. And the pension funds, they will also will attract some of the investors' money. So there's a huge competition in the financial um, uh, sector when you operate. So in the environment, you have a huge competition. Then also your customer wants. Nowadays, since any bank which can't offer online, they will be really handicapped because these days customer wants internet or online banking to do their transactions because of the current situation. So your technological innovations in the environment, those who are really upgrade their computer systems will have a competitive edge. Then the sensitivity, shareholder expectation, capital availability, political, legal, regulatory, industry, financial markets, catastrophic losses are happening in the environment. They are outside our scope, but they are within the business environment we operate. So this uh, environment will always pose a risk to the bank. When competition is high, you will lose business. When customer expectations are which you cannot satisfy your customer, you lose them. Then again, you will run the risk. If you cannot update your systems to a requirement what your customer wants, again, you will lose business. So all these, if the shareholder expectations are not met, they don't want to invest further. If you don't have capital availability, your regulators will come and say your capital adequacy is not sufficient. So all these things are, environment will pose you a lot of risks. Then within the bank, you have process. In this process, only you operate. So we generally we say the financial risk. Process risk, we first take the financial risk because we are a financial institution. Now, the first one, I call it a market risk or we call it price risk because financial risk include three categories called market risk, liquidity risk, and credit risk for a bank. So, the price risk is either the rate, it can be exchange rate, it can be interest rate, or it can be the price of commodity what you are dealing. It can be a price of the shares what you are invested, or it can be a interest rate of the bond you invested. If these prices what you invest and the current market price, the difference, you will tend to either gain money or you will lose money. For example, say today's fixed deposit rate is, we'll say 5%. And customer invest rupees 1 million at 5% with your bank. So you are supposed to pay 5% of the capital to the customer on maturity. Now after 3 months, central bank reduces its base rate through which the interest rates of the market is being decided. You say if central bank reduced their base rate to 3.5, currently it will be about 5, and if they reduce 3.5, you could borrow even money from central bank at 4. So all the monies what you have taken as deposit from customers is kind of also borrowing from customers, for which you pay 5%. Whereas now you have the opportunity to borrow money from central bank at 4%. So there is a gap between the interest rate. So every time you pay at 5% to your depositor, because those have been fixed rates, though it is available at 4%, you will be paying 5% at every month until its maturity. So that 1% is your interest rate risk or the interest rate loss. So financial risk, we call it market risk, is the differential between the price you have invested and the price you have going to pay is or price what you are going to get for new investment is creating a loss. So this loss, very simple example, we'll say you buy John Keel's shares now, we'll say you buy at 140 rupees a share today, and within next 3 months it falls to 130. If the market price after 3 months is 130, and if you had to liquidate your holding of shares, you will run the risk of losing 10 rupees. So that price difference is the financial risk. Liquidity risk, also, banks are supposed to maintain enough liquidity because most of our deposits are pay on demand. Even if you contract with a client to place fixed deposits and you give a receipt saying that it is payable on maturity, I'm sure if a customer comes during the course of the tenure of your deposit, banks sometimes will oblige to uplift the deposits, of course, at a lower rate of interest by making money. So liquidity is required to meet the obligations what you have. So all your savings and current account balance are payable on demand, and therefore you need to keep cash, or you need to keep money in, close to cash, like treasury bills, bonds, where you can pledge and take facilities. So that kind of liquidity is important to manage the liquidity risk. If you don't have sufficient money when the customers demand and if you are unable to pay, you will run a bigger risk than your liquidity risk, because the reputation and the credibility of the bank completely depending on how you make your obligations to your creditors. And if you fail to do that, they even can go to courts. It can even lead to cancellation of license. So it's very important that we maintain enough liquidity to avoid liquidity risk. Third financial risk is called credit risk. We can't keep the monies what we take from our deposits in the tills or in the central bank. If you do that, you don't get interest, whereas your depositors are demanding interest for their money what they have placed with you. So it's like the ship in the harbor. If you need to stretch your hand and lend part of the depositor's money to earn high interest. So doing that, you will have the credit risk. We will be doing liquidity, market risk, and the credit risk as a separate modules. So I'm just giving you a slight example in order to get to know the definition of risk. So credit risk we will discuss in very big, in 2 sessions in detail, and because credit risk is one of the biggest risks for a financial institution. Then there are other risks which will run empowerment, or we call it having the right people at the right places. So you need a good CEO to give leadership to your team. When there are changes, you need people who could change positions and have the multi skills to perform. So here what they're talking about empowerment is the skilled employees. So you need to have that in order to maintain a bank. Information risk is another great uh, subject to think of it. Actually, central bank now demand most of the banks to appoint a chief information officer in the bank, because most of our systems are now work on virtually, and systems has to be protected, not physically, but also in the open web, where hackers could intervene and transfer funds from one account to the other. So we have to really manage our information technology, or we need to have information security for that matter. So this process also need to be put in. Governance is actually your organization, especially it comes from the board of directors. How do you operate the bank with proper policies and with correct people? I also talk about reputation. It's also another important I talk about when we talk about liquidity. If you lose reputation, you can think of sometimes even closing your doors, because if you fail to oblige customers money, sometimes on maturity, they will go and spread the word saying, I went to withdraw my money in the bank, they didn't have, and suddenly we will have huge queues, and that those situation is due to reputation loss, and you might have run on the bank, we call it, large withdrawals coming in very short notice. Integrity also very important subject. Again, it's related to people, and can be it's a it's better to recruit people with integrity rather than sometimes huge multi-skill, because those guys can do internal frauds. So you need to actually look not only the skills, we also need to see the uh, integrity of the staff to recruit. Then all the rest of processes are belong to operations. Now operations is required to uh, have certain processes going. We'll say from the time a customer places deposit, we'll say if you place deposit in a fixed term, you have to accept the cash, you have to get this application filled, then you have to type his fixed deposit certificate. That is a kind of process. Now say these processes are being defined in our operations manuals, and the processes will work with the correct systems, the process itself, and the people who operate it. So these are huge risk areas if you don't do it properly. And errors will occur. Errors will lead to losses, and those losses are all operational losses. So another kind of risk in the bank internally is operational risk. Then I also talk about strategic risk. Then we talk about governance. Governance include, correct transparency of all the financial statements, like public reporting. You have to publish annual report. Similarly, there are other operational areas. You have to keep a budget and make sure that budgets and targets are being maintained. This is overall aspect of a universe of risk the bank will face. Generally, going further, I will explain to you the types of risk a financial institution will encounter. Before that, I want to ask this question. You can note down these questions and think about answer. If you can send me a note, or I'll explain it in brief why banks are different from other businesses. Now, banks are financial institutions, right? Our main business is to accept deposits and lend. And by doing that, you don't want, like other businesses, to maintain plant and machinery, huge buildings. Most of our buildings are on rented premises. You go and set up the thing, you accept deposits, and you pay the rent, and so we don't want to have large amount of fixed assets and fixed cost, because we don't have machinery to convert raw materials into cash. What we need is, our raw material is cash itself. So we don't want to have large machinery. We don't have plant and machinery. So our fixed assets are low. Most liabilities are payable on demand. Now this is very important for you to understand. I told you your savings account and your current accounts are payable on demand. Not only that, if a customer really requires his fixed deposits which have been placed for a term, he could even withdraw at a penalty. So you need to maintain liquidity. You need to maintain cash in order to meet those demands. So what we do is, we operate with no equity. That means we have money coming. Raw material is our money. So when we accept our money, we don't have to go to bank and borrow further money. We take from our customers. We have the license to accept deposits. So our shareholders doesn't have to pump large amount of money as capital to run the bank. So we operate with no equity, and we call it, if you have studied financial ratios already, if you analyze businesses and their creditworthiness, one of the aspects you look into is debt equity ratio. That means amount of borrowing to the amount of capital contributed by the company itself. Generally, we take, for example, we'll take a project loan. If a customer wants to do a 1 million project, he will come to the bank and always say, I am trying to bring at least 25% of the total project requirement, and I need only 75% from the bank. That means 75 is 3, he is bringing 25, it is 1. So it is debt equity ratio. That means the amount of money what he is going to borrow is 75, which is equal to 3 times of the equity of 25% of his investment, which is 1. So we call it debt equity is 3:1. But if you take in a bank, financial institution, you take from bank, and if you had to draw up a balance sheet, we'll see how it looks. I want everyone to take a piece of paper and write a small equation for me. Are you all ready?
Yes, sir.
Yeah. So take a piece of paper. I want you to think of a balance sheet of a bank, but not in the form of what you see in the annual report, but very simple equation. Now, I'll give you some abbreviations, like a balance sheet include your total assets, and on the other side, your total liabilities. So on the asset side, we say current assets. So you can write CA, which stands for current assets. CA plus FA. FA stands for fixed assets. This is your total assets. It should be equal to your total liabilities. So put the equal sign. On the other side, you write current liabilities. In current liabilities, you can put CL plus, you can write long-term liabilities. Long-term liabilities LL plus equity. Equity stands for your capital and reserves. So E. So your simple this equation is goes as CA plus FA equals CL plus LL plus E. Have you got that? Have you written like that?
Yes, sir.
Right.
Yeah.
So
Yes.
current accounts plus current assets plus current fixed assets equal current liabilities plus long-term liabilities plus equity. Now we'll say your bank has a 100 billion total asset base. Now this 100 billion I want to divide based on those symbols what you have placed. So on top of that, each one you can write this. Generally in banks, I said we have a low number of fixed assets. So out of this 100 billion total assets, I will place 90 billion in current assets. So you write 90 on top of your CA. And then your total is 100 billion. So you write 10 on top of FA. Now on the liability side, banks will invest in these current assets only based on the depositors' money. So generally, banks take large amount of deposit from customers. So those are the current liabilities the bank has, because most of them are payable on demand. That's what I put current liabilities. So on top of current liability, you write 85. Then we have another 15 to play. I would apply 5 to long-term liabilities. That means on top of LL, you write 5. And then on top of E, you write 10. Now I will imagine in your paper, it will be like this. Current assets 90 plus fixed assets 10, which is equal 100. And also on the other side, we have current liabilities 85. Then the long-term liabilities LL on top of 5, that is 90. Then the total equity is 10. Right? Now I want you to do the debt equity ratio of your bank. You got my point? Now what is debt? To whom the bank owes money? Banks owe money for his customers. Now these customers are represented, customer deposits are represented in your current liabilities. Plus there are customers who are invested in debentures and other things. They are listed under long-term liabilities. So just see your debt is current assets, current liabilities plus long-term liabilities. That is 85 plus 5, which is 90. Then equity is 10. Then the debt equity ratio for your bank, what you have just created, is 9:1. Am I right? Because bank owes its customers by way of current liabilities and long-term liabilities 90 billion. Whereas your shareholders have put money to the value of 10 billion. So bank owes 90 billion to its customers, which is his debt. So debt is 90. Equity is your shareholders' money. Those are the owners of the bank. Then that is 10. So your debt equity ratio goes as 9:1. Now earlier I was talking about a customer who comes to take a loan. He's offering debt equity ratio is 3:1, which bank thinks quite good because we have to only fund 75% of his total project, whereas he himself bringing 25. So there is a stake put by the customer. So their chances of, if the project is viable, chances of defaulting is low. So when the debt equity is 3:1, we think that project is somewhat credible for you to lend money. And then you accept that project looking at the various other aspects of qualifying criteria, and then you lend 75% of the total value of his project money by way of debt for him to do the project. Now you look at your bank. Your bank has debt equity ratios 9:1. Shareholders have put only 1%, whereas you have borrowed 99 times than the what shareholders put. What do you think that kind of a business? That kind of business is very risky because not like your customer, equity participation is low, debt equity ratio is very high. Therefore, the chances of default by the bank, who is the customer here, is very much high. So still bank people are depositing money in the banks. So that's the very reason why we are different from other businesses. Though our debt equity ratio is 9:1, we have been operated and regulated by a central bank. They looked at all the risks what the bank is taking, and they give due consideration to manage all this risk. They will make sure the depositors' monies are safe. They sometimes even ask you to take insurance against the deposits. So all that, when you think about it, so banks, though the debt equity ratio is very high compared to business, since it's been regulated by the central bank and with proper processes, we are good risk managers. So as a result, customers still go and come and put money with us. So this is the difference between bank and normal business. But sometimes, great accountants say the most riskiest place to put money is in the bank because they go by the debt equity ratio, and when you look at debt equity ratio is 9:1, that's the least place what you think because that's the highest risk in their operations. So we also have banks are different because we also have the responsibility to safeguard our customers' funds and to maintain the stability of the banking and the financial system. As a result, we follow rules. We do all compliances of the central bank to maintain all those credibility and stability. Therefore, we are slightly different from other businesses. Now, please keep the sample balance sheet which I did for your bank, because I am in going forward, I am going to go a little more elaborate on that for you to understand other type of risks. Going forward, these slides, what you see on the screen, has it's a triangular thing where on top you have profits, then you get customer deposits and you place capital. I have put some currencies under the capital, money what you get from customers, and then there's a small portion of capital, and these monies have been invested on the growth path by taking risk on the other side, and if profits are made, it get accumulated to the capital. So this is the risk triangle. So if you want to maintain higher growth, sometimes you take higher risk, and if you can balance all three, that is to take risk with proper management, and then employ your capital accordingly, and see that the bank growth rate is being achieved, then you can have your objectives being achieved. So rest you don't have to worry about. This thing that very simple reason we say it's a balancing act. Higher the risk, higher the profit. But when you're trying to take higher the risk, if negative occurs, you might even lose the objective profits. So you need to manage your growth, you need to manage your risk in order to achieve profits. Now I am really coming to the proper financial sector. All this while I just gave an understanding for you to gather type of financial institutions in the financial sector, then in what environments we operate, why we are different from other businesses, why we need to manage risk proper because our debt equity is very high. So we looked at from this slide. This slide is very important because I may pose some questions on this definitely, because the last time also I raised questions on using this slide. So you need to remember these slides proper, because this covers all the risk what a financial institution takes. I have divided the risk of a financial institution into three types. One is financial risk. That is the highest risk because we deal in money. And I told you earlier, the financial risk has further three aspects: credit, market, and liquidity. The market is the price fluctuations which I discussed. Liquidity is the amount of money available to meet customer obligations. Credit is the amount of money what we have linked to customers and their recoverability. All these are linked to financial risk. Then we operate institutions, and those operations, we need to have systems, we need to have people, we need to have processes. All those will be managed through an operational platform. And if you have failed in any of those areas, you will run into an operational risk. So second major item in the risk types of the bank, first one, the financial risk, that has three categories. Then the operational risk is pertinent to your people, systems, processes, and any other external events. Then we have strategic risk on the other side. Those are the decisions, the policies that your board and your senior management take in order to take your bank forward. Your marketing ideas, your planning for future growth, your budget preparations, all the strategic events where, any decision, wrong decisions may lead to losses, and so strategic risk is such. Then you see these circles will cross each other and create one hub. That hub I have put where all the circles mingle together in the middle. That hub, I have put it in yellow. I call it compliance risk. or I call it regulatory risk. It's another, that's the fourth type of risk, major risk of a bank. You need, I told you, we have a high debt equity ratio. Why customers still put money? Because they know bank is being regulated and guided and directed by the Central Bank of Ceylon. So as a result, depositors think their monies are safe in the bank. So bank also need. So those violation of those regulations or directions will lead to compliance risk. And then on the sides, I also talk about three other areas. I also talk about reputational risk. Uh, we do our business based on the customers think that the most safest place to place money is the bank. That's the reputation we have. So we need to maintain that reputation and we need to maintain that standards so that our risk related to reputational risk will not occur. We should not have large number of customer complaints. We need to, if there's a complaint, we need to attend quickly to those complaints and resolve those. Otherwise, what will have is the reputation of the bank will diminish, and the people, your competitors, will grab those customers. And as a result, you will lose profit, and finally, certain errors are, they can even go to the regulator and complain, and you will be subject to certain fines and legal action. All those will happen if your reputation is lost. We also deal in a lot of contracts, and so as a party to a contract, bank also need to oblige to the conditions of each contract. That's what the legal system, how it works. So if we don't do it, we can run into legal risk. Very simple example I can give on this. You have got an employment letter. After 6 months, you finish your probation and you get permanent. Right? Suddenly, if your manager doesn't like your face, he will come. He will ask you to go. I don't want to see you from tomorrow. Stay at home. He take a very drastic act. To fire you. You have the option of going to a lawyer, going to a labor tribunal, file action against the bank, and such banks have such actions not only from employees, from various other contracts they have got into, and such actions will sometimes result in huge compensation, and those compensation will lead to loss of profits, and therefore it's a part of risk. So legal risk also banks will have to manage. Then the latest one is the technological risk. We operate most of our system on computer platforms, so you need to see the integrity of our IT system, machines, various other things related to technology in order to safeguard our customer information and not to allow external hackers to get in and defraud the bank. So these are the major risk types as a banker you face. So whether you are in many departments, you will face one of these risks. So mostly you will face the financial risk because you can be in credit department, you can be in your finance department, you can be in your treasury. They are subject to this. Whether you are in operations, you are subject to maintain your processes, your system should work properly, so you will run into operational risk. Those who are think tanks of the bank, who are actually corporate management, who create strategies of the bank, along with marketing department and various other corporate departments. They also need to manage their strategic risk, right? Otherwise, we will have problems. So we will have legal action, legal team. We will have, technological team. We will have various other customer care teams to maintain rest, reputational, legal, and technological risk. To manage this all type of risk is the subject what we have. So to manage risk, better to know the risk types what you're going to manage. That's why this particular slide is so important. So once again, I put forward our course in the format what we are going to cover, how we are going to cover in next 12 weeks. Today we are going to see the definition of risk and risk management. And next week we are going to touch a subject called integrated risk management. Integrated means together. That means all the type of risk what I have mentioned has to be managed not by separately, but has to be to one unit. One coordination has to be managed to one framework. So that's, we call it integrated risk management. Credit risk management, I told you, credit market liquidity is 3 financial risks the bank face. So we are going to touch on those 3 in one particular session. So because these 3 things need to be managed proper if we have to manage the risk in the bank. Then we also have operational risk. I told you, with people, systems, and processes need to be managed, and through operational risk only we will manage that. Information risk related to your systems, computer systems, and various other systems what you operate. Compliance risk or regulatory risk also need to manage, because you need to see that you follow all the rules what your regulator you put forward. If you fail that, you will be subject to fines. Finally, even will lead to cancellation of banking license. Strategic risk. Strategic is the long-term planning, so which your corporate management does. So these decisions will also run into risk if it is not properly done. As a result, strategic risk is actually to relate to your competitors, related to your customers. So based on your strategy, you can deal with them, and as a result, you will manage your strategic risk. Corporate governance is another area which your board is concerned. How board is responsible to make policies and see that bank manage its risk, all the risks proper, so that profits can be shared among the shareholders and all the other stakeholders. So these are the areas we are going to discuss. Credit risk is little vast subject which we are going to cover in 2 sessions, and the areas, even sometimes operational risk, we may run into 2 sessions. Rest each subject which I am going to manage with 1 session each. So going forward on today's definition of risk, we have some more slides which also give another idea for you to know what is the type of risk that we have. I told you there are 3 major financial risks, that is credit risk, liquid risk, and market risk. In credit risk, what we simply, we look at the asset quality of the bank. Now, I want you to take the balance sheet which we prepare. your paper. And your paper, you will have, I want you to see where the credit risk occurs in your balance sheet. Do that, I will tell you. Now on top of your current assets, the amount depicted is 90, right? Now below that current assets, I want you to list what are the current assets of a bank. Anyone can unmute and tell me what are the current assets of a bank if you have had a look at the balance sheet of a bank?
Loans.
Yes, loans and advances, yes. Loans and advances are actually credit risk. So you have really hit the point. What are the other current assets?
Cash and cash equivalent.
Yes, very good. Then cash and cash equivalent is, we need that manage liquidity risk. So your current assets, if you manage your current assets, you can manage credit risk and liquidity risk. Now related to market risk, what you have in current assets? Now all the money what you get from your customers, you don't give them as loans. You need to keep cash. Actually, central bank has a requirement or liquidity ratio, statutory liquidity ratio. You need to maintain, I think it is 21% right now. You need to maintain 21% of your total current assets in near cash or near cash items. So you said cash. Cash and near cash items are sometimes money with the central bank, money in your vaults, money in your ATM machines are, we all call them cash because you have access to that. Then the near cash is what you can convert into cash quickly as possible. And generally, those are the type of investments which you can convert. So the next item in your current assets, I would list in such a way, I would list cash first, then I will list investment second. Investments include your portfolio of treasury bills, treasury bonds, your share portfolio. If your bank is dealing in gold, the stock of gold or any other commodity, those are all near cash items which you can sell and get money to meet your customer obligations. So liquidity ratio, so total assets, total current assets, you need to maintain, we'll say 21% of liquid assets. So I will now put under current assets, I will put 3 items. The first item is cash. Second item is investments. Third item is loans and advances. So you can write down in your balance sheet under current assets, cash, investment, and loans and advances. Now we are going to put some figures into this based on your balance sheet. You think now we have total current assets of 90, right? Bank is supposed to maintain 21% of total assets in liquid form. So your total assets is 100. What is 21%? Is 21 billion has to be divided between cash and your investments. There is another ratio called reserve ratio by the central bank, which says you have to keep about 7% of your assets in cash. This cash can be, I told you, cash can be in your vault, in your counters, it can be in your ATM machines, or even in your current account with central bank is cash. So this totaling all these, you can keep 7% of your total assets. So I put a dash against cash and I put 7. Then we need to make 21% of total liquid assets. So 21 is, we have already put 7. I put investment dash, I put 14. That makes 21%. Now under current assets, you have only 90. 21 has been already allocated. The balance is 69. So you put loans and advances and put a dash and put 69. Have you done the total current assets? Have you given value to total current assets under each category? Cash, investment, loans and advances. Someone has done, please say yes. You understand what I says?
Yes.
Right. So thank you very much. I think now we are actually constructing our balance sheet, and in that balance sheet, current assets have 90 billion. Out of 90 billion, we have cash 7 billion, investments 14 billion. We have 69 billion in loans and advances. Now, why credit risk is so important? If you see that your entire balance sheet only 100. Out of 100, you have lent to customers 69 billion. So 69% of your total balance sheet is not managed by you. The monies are with your customers. Of course, it's managed by you, but the monies are with customers and they need to pay you back. So it's all of them are not going to pay, and some of them will default, and as a result, you will have credit risk. So your asset quality in loans and advances, that is one of the biggest assets what you have is loans and advances. And the quality of that depends on whether you will have all the advances are regular. That means all the advances in terms of banking is a performing advances. If all your advances are performing, your NPA ratio is 0. That means you don't have non-performing assets. But in an ideal bank, at least there is 2 to 4% or even higher NPA ratio is there. And if you don't have that, I would say you are only lending to customers who have placed deposits, and it's like the ship in the harbor. So I don't think bankers will do that. Bankers will take credit risk and lend to customers after proper evaluation. However, you do evaluation, the market forces will tend for failure of businesses. When that occurs, banks will also have credit risk. Now we'll take, for example, before the pandemic, one of our best performing industry was tourism. And banks are willing to lend to this particular sector so much, and one of the preferred sector for credit is tourism and transport. Now what happened? Suddenly an external force came and everything came to a standstill. And the monies what you have been disbursed are probably either restructured or they are transferred to non-performing. When you transfer your credit facility to non-performing, your asset qualities get downgraded. So credit risk is mainly the quality of your assets. Liquidity risk is ability to convert your assets into cash. Now, we looked at your current assets. Under that, we say cash. Cash is complete liquid. Then on top of that, um, give me a second. Hello. Hanggang kaling contact na dami. Apa kamu nak kian na lecture ni? Okay. Sure. Sorry about it. So liquidity risk is your ability to convert assets into cash. Part of your current asset is already cash. The other is some investments. Investments sometimes, if you have investments like treasury bills and bonds, of course, you can pledge those and take facilities, or you can even go to the market and sell them. If you have shares, you can go to the market and sell. But banks generally, we are responsible for our depositors' money. While these conversions are done, we always make sure that we make profit. So we keep good amount of money in order to meet the liquidity requirements. So because we also have a cash flow coming from our loans when they get repaid. Therefore, we not only rely on investments and the cash what you maintain, because there are regular inflow of repayments coming from the rest of the portfolio. So we maintain liquidity in order to manage the liquid risk. Market risk is adverse movement of interest rates and prices. So these are actually investment decisions. The investments are done on shares or whether in gold are based on how the prices will increase in the future. So based on that, you take this risk, and your treasury is geared to. With their studies, they will gear to understand how the market operates, how the share market operates, and place their investment in such a way that they will see that always that they make money. Operational risk is there's a definition to this: loss resulting from inadequate or failed internal processes, people, systems, or internal events. At the moment, if you can remember this, it's good enough, because you make losses when people make mistakes. You make losses if your processes in the banks are, it's not streamlined, take longer time. Then your systems are default, then there can be losses. Or any of the external events like flood, fire, external fraud, all those events will result in losses. So operation risk is managed with people, with proper processes, and you see that systems are in order, and you make sure that your external events are covered under insurance. So this is a very important area which we are going to study, how this is being managed in a separate module. So we'll have credit risk, we'll cover in 2 modules in the future. Liquidity risk, 1 module, market risk, and operational risk. Sometimes we may run into two areas. Compliance and regulatory risk is you need to actually see what your regulator is. You need to be thorough with Banking Act. You need to thorough with the directions given by central bank, and based on that, you have to see that you operate within those laws and the rules that have been given to the bank to avoid regulatories. Legal and reputational, these are sometimes unforceable contracts. To get into a contract where you can't oblige with your part, then what will then become unforceable? But then the other party can go to courts and file action. May result in future compensation, penalties, and other things. Those also kind of risk. Capital or solvency is you need to manage assets to see that you maintain. There's a thing called capital adequacy. So also another central bank regulation to maintain a level of capital adequacy to not to get into a solvency situation. Solvency is a kind of bankruptcy. So these are the things bank when we need to take risk in order to make profit. Now we go into each type of risk what we have tried to give another further definition to what we have mentioned. So these are for your literature and for you to note down what is, if someone says what is credit risk, it is simply say, you can say even the asset quality or something like losses associated with default. So credit losses will come, credit risk will arise when customers default, and the potential loss for the bank will occur when customers default. Now you need to remember here, the credit risk, when we are going forward, we will discuss further categories. Credit risk is related to customers, or the borrowers. We call them counterparties. When counterparty fails to meet the financial obligations, only the losses, credit losses will come to the bank. So to avoid such losses, we need to manage credit risk. How do you manage this? You need to evaluate before you give counterparties loans and various other things. Those we will be discussed in very much detail. Before we take a break, I will look at the definition given by the World Bank or the Bank for International Settlements, because in their risk categories to Basel, this is what they say, what is market risk is. Market risk has 4 other categories called equity risk. Equity is related to investment in shares. And if you lose money there, we call it equity risk. Interest rate risk is, it could happen to your investments, those who are interest-bearing investments, or it could happen to your products, interest-bearing products. We have, most of our products are interest-bearing. We'll say, I took example, now say current fixed deposit is 5%. If policy rates of the central bank go lower, you will be able to borrow at lower interest rate than 5% from the central bank. If that happens, fixed deposit rates in the future also is going to go down to 4%. Whereas you have contracted with customers in the past to give them 5% until it is maturity. So from today to that maturity, you will be paying 5%, incurring a loss of interest of 1%. That loss also we call it interest rate risk. So you will have, similarly, you have leases in the bank. Leases are for a fixed term of, we'll say, 5 years. So you agree to give a lease today at, we'll say, 8%. And until the lease is being fully paid in 5 years, interest rate applicable to the total amount what you gave is 8%. If the market rates increase in the market the next year, leases, we'll say lease interest rate goes to 10. So the new leases you are going to give at 10, whereas your old leases are going to give you income of 8%. That 2% loss what you are incurring from the previously arranged leases is also interest rate risk. So market risk has equity risk, you have interest rate risk, you have currency risk. I call it a currency, it's the exchange risk. Banks need to maintain accounts in different currencies in their correspondent banks in overseas, because they draw instruments, either drafts or TTs, or those settle their LCs, various other things in different currencies. And so this value of these currencies actually fluctuate. For instance, dollar today, say if you have in your correspondence account and in your treasury, you will have, we'll say, $100,000 today the balance. A positive balance. Positive balance means to the credit of your bank has $100,000. So this 100,000, let's say today's exchange rate is 203. So you multiply your 100,000 into 203, and you put the value in your balance sheet from your currency as debt. So your balance sheet carries 203 times into 100,000, where dollar currency is concerned. We'll take, for example, tomorrow, this value of this dollar will rise to 205. Then your balance sheet read 205 into 100,000, giving you 2 rupees profit on each dollar you maintain. So you will have 200,000 rupee profit the very next day because of the exchange fluctuations. That 200,000 you take as foreign exchange profits. Imagine from 203 to tomorrow it reduced to 202. So your balance sheet will look at 202 into 100,000. You will have a 1 rupee loss. 1 rupee into 100,000, you have lost 100,000 rupees due to that fluctuation in one day. That loss you mark to your P&L as foreign exchange loss. So taking that loss is the currency risk. So generally banks will decide based on your predictions whether to maintain a positive balance or negative balance, or borrow money and keep it. The currency is going to appreciate. That is how you manage currency risk. Commodity risk related to, commodities like gold, especially I touch gold because most of the banks in Sri Lanka, they deal in gold. Rest of the world, commodity can be include lead, oil, various other commodities in the open market in the global trade. So Sri Lankan banks generally don't want to get involved in those aspects because we don't have the access to those markets. And so what we do is we deal in commodities, mainly the gold, and banks buy gold at a particular rate, and then maintain stocks, and then the prices move up, they can sell at a higher price and create a profit out of it. So while doing that, if the prices go down, similarly they have to take the risk of holding a commodity like gold. This is what you call market risk. Now what I'm going to do is we'll also look at the liquidity risk, and then we'll take a break. Liquidity is to go into further clarification of what it is the ability of the financial institution to ensure that sufficient funds are available to meet its contractual and relationship obligation, such as if you agreed a loan, you need to disburse on time. If you have deposits maturing on a particular date, you need to have funds to meet that. Don't think that depositor will come and roll over it, but you need to have liquidity maintained to meet those obligations. So these obligations can be met not only your available funds, but you can borrow money and pay them. That's what the government does now. The government get into debt, and they have to pay those debts. They borrow more money, but when you borrow more money to pay, you will have to borrow at a high price or the high interest rate. Then you, by trying to manage the liquid risk, you create an interest rate risk, and then you with the price risk you run into a market risk. So at a reasonable cost and price, if you can manage this, that is what we call managing the liquidity risk. So I want to end up this particular first session of today with the quote, financial systems runs on confidence, and when confidence erodes, it erodes quickly. And to describe what it is, I always told you about the reputation risk. Reputation is about confidence. If you are a reputed bank, people have the confidence to come and do transaction with you. And if your reputation is lost, the customer confidence also will lose. And when confidence lose, and it erodes quickly, and so you need to maintain liquidity, not to get into a situation of having into reputational issues and confidence issues about your customer. That you need to meet their obligations, contractual obligations, in full and on time. That is how do you manage your liquidity risk. So we'll take a break. Now it's 3:30. We'll take about 20 minutes, and we'll meet you for the second session. In the meantime, if you have any questions, you can send me a note. So during the interval, I can look at it and answer. Thank you very much. I am back. Can you hear me? Can you
Yes,
hear
sir.
me and see? Yeah. Can you see the screen also?
Yes, sir.
All right. Thank you. I got a query from Mohan Gurusingh. Mohan, what you are asking, is it similar to hedging contract? Yeah, actually hedging is also dealing with the derivatives. So, which is also, we call it, we hedge the risk. Hedging is instrument, you can use various type of instruments, derivative instruments, to hedge the risk. Hedge the risk is to mitigate the risk Those are the terms what you use. That is to how do you manage to reduce the risk. Risk is the hedging. Now to explain to you what is hedging, what has happened in Sri Lanka, and people misunderstood it in different way because we made a loss, because I told you in risk taking either you can have a positive risk or a negative risk. Now in this hedging contract what we entered with a Singaporean firm by the Ceylon Petroleum Corporation went into a negative category because when they started hedging, what they went on this basis. The oil was trading around 62, suddenly it went up to about 85, 90. And world's prediction was it will reach, it went up to 87, and then at the time of hedging, it was about 115. So the world was predicting, the market were predicting it might even go up to 200 at that particular time. So CEP contacted the banks and they entered into a contract with the supplier in Singapore to buy 200 million barrels of oil throughout a year at the rate of 125. So when it is at 115, we thought it might go up to 200, and we fixed the price at 125 and did a hedging contract. Hedging is they use a contract called options, instrument called options. So we took a option of buying oil at 125 throughout the coming that particular year to a maximum of 200,000 barrels. So then the price moved up again. It reached 125. We bought at 125. It moved up to 145 level. Still, Sri Lanka was buying at 125. That was after 2 months after the contract was signed. Then after 2 months, it started dropping. And finally, it dropped down to about 62. And we were still buying at 125. So that was the problem. The first 2 months, we made a lot of money because from 125 to 145 was the market price. Still, we are buying at 125. So every barrel, $20 have been saved. That time, the risk what we took in that contract was a positive one. Then the next 10 months, it went below 125 and it reached even the level of 62. So he making a huge loss for the Ceylon Petroleum Corporation. So that was the hedging deal Sri Lanka had. So hedging is another technique what we use to mitigate risk in commodity purchase, or we can use that for currencies. We can use for any type of kind of a market risk management technology we use for hedging. So I think that would answer Mohan's question. So going forward, we looked at liquid risk and operational risk, and then now I come to compliance risk, where we stop was operational risk, right? So compliance risk is related to law. It's legality or directions issued by the regulator. If you are not violating any of these laws and rules or standards set by central bank, we say we are compliant with the regulator. So as long as you are compliant, because we need to submit a compliance certificate to the regulator every 6 months saying that the bank has taken all the compliances, we are not violated any. Now to tell you one, we discuss about statutory liquidity ratio. Now if the central bank says it's 21, banks are supposed to maintain well about 21 all the time. I mean, you cannot violate that. Moment you violate, there's no excuse. They can even introduce penalties, and then we may have to actually sell some of the assets which can be converted into cash and make that liquidity. So not only that, if we violate, we have to pay a penalty. We may have to quickly restore those standards and then creating a loss. So compliance not only will result in penalties and various rulings by the regulator, but also it will have to, in their compliances, in subsequently, we may have to suffer losses, in other forms of risks. So it is, now they say compliance is responsibility to the board of directors and the senior management and staff. So compliance is everybody's business now, and therefore we need to be very careful on this issue also. Strategic risk, I'm just repeating some of the things. It is to do with customers, competitors, suppliers, and investors. Company or the banks will have to develop strategies to deal with emerging markets. Now, say, who thought telecom companies will be our competitor? Now, you say those days the fund transfers only can be gone through the banking system. Now, I think telecom companies through easy cash and various other methods what they have found will be a direct competitor to us in that particular business. Similarly, we went into other businesses like, pawning, which has been only the business of pawnbrokers. We have taken those businesses. So now banks are big players of pawnbroking. So these are some of the strategies within the bank we create, within the rules allowed to us to deal in various products of the bank. With that, we are trying to maximize profit. So strategic refers, it differs from industry to industry, but banking, it's very difficult to create strategies, to create a strategy for your own, because interest rates are similar to in all banks. Type of products we offer are the same as the other banks. So the best strategy for a bank is to provide the unmatched customer service. So I think what they say is we have to develop customer satisfaction to the great extent to have a edge over other competitors. Other than that, if you increase your interest rate, tomorrow your competitor bank also will come into that. If you have a product for minor savers, they will also bring another product for minor savers. So there's no big advantage in the product base what we have, or the type of operations we have. So main thing is should come from the customer service, where you can get larger market share through that strategy. Now we come to, so we looked at the type of risks. Now we come to risk management. Now from here onwards, we are on the proper path to our subject. These are very important statements which I have made on this slide. The process of identifying, measuring, responding, monitoring, and controlling and reporting risk with the view of increasing financial strength of the bank. Now, risk management, like in all the other managements, it's a process. Now, say you say management means a process. No? You plan, organize, then put into action, and then achieve the results or the output. Now, risk management is also a process. Now, in that process, to manage risk, we need to identify. We need to identify what type of risk we have been faced with. That's why our earlier slide will be very important to you to know the type. Is it the credit? Is it the liquidity? Is it the market risk? Is it the operational risk? Is it the reputational risk? Is it the regulatory risk? So you should be very familiar with the types of risk what the banks encounter. So to identify, you need to know the type. So you identify credit with credit. Now say, for example, I'll take a credit facility. Now, so it's a process like in any other management. The process we started identifying. So to identify, you need to know the type of the risk. Now, I was trying to give you an example of a credit facility. We'll say you give a credit facility against a mortgage of a loan. Now, these customers, you have done your evaluation, and based on that, you found that he's creditworthy, his income and other things are all right. But you also take a housing, you also take a mortgage over his property as collateral. Now, while taking the collateral, bank made a mistake. We'll say security documents are not in order. Probably he may have not got the proper title to it, or the mortgage bond what he has signed is not properly authenticated, or it is not properly registered. So you may have done some form of a mistake in taking the collateral. Now this customer default, after say 6 months, after paying 6 months his installments, he default. Now his default is a credit risk. Now what we'll do is to manage the credit risk, you have to recover. You have to recover capital plus interest. So now we have to resort to the collateral what we have. So we go to courts with the mortgage what we have, with documents which are not properly executed. Now at the courts, because of the documentation improper, we lose the case, and he goes off the hook and we have to suffer that loss. Now that is not a credit risk. While trying to get the documents in order is a staff member who is involved. The process what is there, the system placed in the bank would have created a part in getting the proper documentation. Now if we have failed in that, that risk is called operational risk. So in one facility, you have two types of risks. So identifying a case like that, you need to identify you have to identify the non-payment as a credit risk and losing the money as operational risk. So these are important to identify this. The measuring. Now, to manage anything, you need to see how much. So we also need to know, in case this risk occurred, the type of risk occurred, how much we are going to lose. So if we can know, measuring before we take the risk proper, we know how to manage it. So one of the important part of risk management is to see the amount of money what we are going to lose if we enter into this particular transaction. Now, we have certain measures for various things, but some of the things are you need system support to do measure. Now say if you take a loan, we'll say I go to the bank, I ask for a loan for 5 years, and because of my credibility or whatever, bank says okay, we will allow, just give us some kind of collateral. Say if my facility is 1 million, I give a collateral value of say 200,000. Now 800,000 bank has given me clean. Now after 6 months, after 3 years, I default due to not willingly, but say I may run into problems, non-employment, sickness, various things could occur to a person. No? So then bank has only collateral value to 200,000. My exposure will be about 400,000 because 3 years I have paid about 600,000. Now, how can bank will come to know before they disburse me 1 million whether I will run into a problem after 3 years? Nobody will ever think of it. Now, there are ways of doing these sort of measurements using various aspects, which we will discuss when we are doing credit risk. So, doing that, we will be able, even before disbursement, we can see how much money we are going to lose on a facility based on certain measurements. So, measurements are also important, and there are ways of doing it. Responding. Now, say, here measurements in a credit facility can include evaluation also, because before we give, we properly evaluate a customer. Similarly, if you want to invest in shares, we evaluate that particular company's strength, ability to generate profit. All that, we evaluate before we embark on such an investment. So measurement include those evaluation also. Responding means either to take the risk or to avoid risk. Now say we'll take a credit facility. Your credit officer will process the papers and do a credit memorandum or credit appraisal form or approval by the higher authority. So that process we call it measurement or evaluation. When it goes to the higher authority, he also looked at various aspects of the paper, and he will either approve it or decline the facility, giving reasons. So if he approves, we say responding positively. If we decline, we say responding negatively. So the process has 3 steps now we have discussed: identifying, measuring, and responding. Once you accept a facility, or once you approve a facility and accept the risk, you can't just wait, because we work in a very dynamic environment in the financial market. Things change overnight. Customers' positions will change. Therefore, you need to monitor. Now, say if you give a loan for 1 million, and next month, if he doesn't pay and if you don't follow up, he will actually default the very next installment also. So monitoring is an aspect, in risk management. You need continuously do it. Then if you think the risk is very high at a point, you need to control. Now say if you are losing money on one kind of a product, you can even control that product by saying scrapping that product from there and say, okay, if you are to do pawnbroking at a particular location, if you are going to lose money there, all the items which are coming are dud ones, and there's no proper control, you can even scrap the pawning center attached to that particular place. That type of things are, we call it controlling. And the final phase is reporting. All the things, now say in banks, we say management reports is submitted to the corporate management. Now say if your loan portfolio details, there are periodic returns which you need to submit to your high authority. Similarly, risk also need to be reported. Now, particularly risk, you need to report to a subcommittee of the board, because your chief risk officer, we call it CRO, has access to the board going above the managing director or the CEO to report risk. So reporting is also part of this management process. So you have to remember the 6 steps what you have to take in risk management. Identifying, measuring, responding, monitoring, controlling, and reporting. So if you do all these 6 steps in your risk management process, you can manage the risk. So first, identifying is, you don't know what type of risk you are involved, and then measuring, you know how much you are going to lose, and if the amount you are going to lose is high, before you disburse, you can respond by declining the facility. If you're going to know that you're still going to make money, you can respond positively. Thereafter, you can do monitoring, controlling, and reporting to make sure that your risk management process get fully completed. Then next item in the risk management is, I already told you, need to identify the type of risk, credit, operational, market, liquidity, regulatory, reputational, legal, strategic, and all that are mentioned there. Then another important area which I want to give you as homework for today. If you go to the website of Central Bank of Sri Lanka, there is something called directions to licensed commercial banks. Under licensed commercial banks, you will have all the directions are published. In that direction, in 2011, they gave a direction number 7. This direction number 7 is related to risk management. I'm sure if you can download and print, I'll be very happy. Or even if you download and keep it, it's all right. Because this is a very comprehensive document. You will not understand it as you download it. But while going through this process of learning risk management, we are going to take part by part of that document and then explain to you why Central Bank wants to give the licensed commercial banks such a direction of managing risk, because they have studied risk management to a very great extent with the support of the bank staff. In 2011 on from 2007 in Sri Lanka, they wanted to have a risk management department in all banks. But however, the directions or the documentation of proper how to do it came up in 2011. And 2011, they issued this direction number 7 of 2011. It's a very comprehensive document and which will give a complete framework of how to manage risk in commercial banks. So it's very important. I hope that you will download this particular document and keep in your custody. So because our future requirement, you may be touching some of the parts of that document, and then you will come to know understanding of the value of that document, why Central Bank has gone into such detailed description of risk management in banks and creating that framework for us to understand better. We also need to understand risks need to be managed integratedly. Now, I also said that our next subject for next week is integrated risk management. Integration is to combine. We also call it risk in a bank has to be looked or viewed by a helicopter, because why I say a helicopter is you look from above. You need to see everything what's happening in the bank which relate to risk. Now in banks we have policies, we have processes, we call it procedures or methodology, and we have structures to manage different risks. Now risk management framework provides that. Integrated risk management framework provides that policies. Now, before risk management was introduced, banks had procedure manuals. Now they are called policy manuals or policy stroke procedure manuals, because all those need to be approved by the board of directors. So policies of the bank need to come from real top, from the board of directors, recommended by the management, and the board of directors will review it and then they approve it. All the processes, all the policies. Now, number of policies we have are very large in banks, and if you happen to come to know some of the policies, it's better to read it and understand. We have policies for credit, we have policies for operations, We have policies for risk management. We have policies for information technology. We may have procedure for corporate governance, various other things. All what we have listed, what we are going to study, there is a policy. So if your bank has that, I know these policies are private and confidential documents. If you happen to have a friend in risk management department, you can access some of the policies. Similarly, if you are in a department, you will have procedure manual, because how procedures have been structured for you to how you do your day-to-day work. So those also been some are included in the policies. So best thing is to have a look at it and make understand. Structure means your organizational chart. These are very important. You know, banks are highly hierarchical companies, so I would say hierarchical organizations. Now, say if your entry level may be a banking assistant. Now, one will understand how many promotions you need to get before you become CEO. It's not very easy. At least you need to have more than 10 promotions to reach the top. As a result, you create structures. Now, say your branch, if I bring a credit proposal, originally it will be prepared by a credit officer. Then he put to your branch manager. Probably your branch manager may not have the authority to approve it. Then he will have to go to the regional manager. Even if he doesn't have approval, he will go to head of credit in your head office. Sometimes some facilities, even he can't approve. He will refer to a CEO. If the limits and all that were even above CEO, they will put to an internal credit committee. And above that, sometimes certain facilities will go to the board of directors. Now you see the hierarchy. One process, how many hierarchies are involved? So similarly, these structures have been created to facilitate management of risk. So it's for us to better to know when you're doing risk management, you should know the policies of the bank. You should know the procedure manuals or the methodology involved. You also should know the structures, how the approval process take place. Then you will be able to manage the risk properly. Risk management should be viewed as a third leg of shareholder value. So a lot of people think risk management is isolated internal department or in-house department. I'm sure it's true that because they don't go and meddle with the customers. The people who are in the business lines, they have to always meet the customers and have interaction with them, promote growth, promote businesses. But the risk management department is kind of a, back office business. They think that they don't add to productivity, but certain monitoring, certain risk, measuring and identifying risk, and educating rest of the business department is part of risk management. With that, you reduce lot of losses, and reduction of those losses will increase the profits. When you increase the profit, you are actually increasing the shareholder value. So risk management, you have to understand in that sense. Now I will go to individual items of risk identification. In fact, I already explained to you how do you identify, but we'll look at this slide dose and see. When sun is shining, no clouds are on the horizon, or businesses on growth is right time to think what may go wrong. We had a good time before the COVID. Country was progressing well. Tourism, there was a boom, and our reserves were very strong. People who employed abroad start sending money. So GDP is on a positive note. Manufacturing things for them. There's no restriction on import of cars, so the business was as usual. And that was when in normal conditions. And nobody thought that we will have a problem of this nature, which will affect our business to this great extent. That's why they say risk has to be identified when it is not happening. It's no point identifying risk once it occurs, because then your losses have already been added to your profits. So best thing is to do identification process. We call this process, we call it as a test we run during good times of various things. We call that stress. That test is called stress test. In case something of this nature happen, what will happen to our profit? What will happen to our liquidity? What will happen to our capital adequacy will be computed with that test. So we identify risk sometimes in good times where the risk is not being shown. Now say, for instance, sometimes your risk management will send a circular to operations department of your business. Say you are in cash department. Think about the 3 risks your department will have going forward. So you will put your entire thing can and thinking hats and always think what will go wrong. What are the risks in our cash department? There are a lot of risks. External risks like robbery. Are you prepared to bear that? You have the proper police signals, you have the proper alarm system. All that are to identify risk has not occurred. But you know why you have taken all those precautions? Because you identified that in good times a robbery could take place. Then now those days we have these counting machines. Now I think some of the counting machines can detect forged notes. So why this has been identified? Because in the past we had lessons learned. During the course of your business, you have encountered counterfeit notes and they have been detected, and thereafter you don't know from whom you have got it, and then it would have been lost to the bank or left to the particular teller. So these are kind of methods where you can identify. I have put scenario analysis and conduct of stress test to check the impact on returns if really occurs. Now, if we had known that COVID will come 3 years ago, we would have done a stress test and say, okay, if COVID comes, tourism will be going to zero. Our exposure to all the facilities what we have given to hotels and various tourism-related sectors will not pay us. As a result, we will have this much of NPA. When that goes to NPA, we will have loss of profit and so on. So that kind of a test, then you have to actually give grounds. Why do you think like that? If we had done that when the first patient was identified in China, that COVID is going to spread to world over, probably that test we would have carried out and taken precautions. We would have reduced our exposure to tourism, or we would have get more collateral out of all those facilities, and we have done something. So that kind of identification is required to do risk management. So we can do brainstorming sessions, workshops, and various other risk control, self-assessment methods. Self-assessment is the one which I just told you about. Risk management will send you a notice saying that cash department identify 3 risk events. So you can say forged notes, external robbery, or you can say whatever. Internal fraud, you can do all that and write to them. Then they will check back your history, whether these have been occurred, what controls you have in place. If controls are not there, they can suggest you the authority to have these controls. Now, some of the controls I can say is, short received or whatever, tell us very often we'll have cash shortages. So as a measure, we have some CCTV cameras. Now we have focused on the tellers. So to identify the movement of the customer and how the teller has worked, done that transaction, that might help identify the mistakes proper. So these kind of identifications are done to various processes in the bank. I just took one example to risk identification. So it's very important when you manage risk, you need to identify the risk. Now that's all. Actually, we have come to the second part of it, but I will summarize because since it's the first lessons, what we need to know. I will give a small question, and we will discuss that question. In fact, actually, this question I gave it to one of the past papers. I actually listed this question. It's a small part of the questions covering this particular section. I still can remember. Let me see. Yeah, it goes like this. CFO of your bank, CFO, Chief Financial Officer, states that the biggest risk in the bank is credit risk. Right? Now that is his statement. CFO states that the biggest risk in the bank is credit risk. Now I will ask the question in that the second part is critically analyze his statement and explain your findings. So that was the question, and actually it's a two-part question, and this was the first part. So that can be answered, that question can be answered from what we have learned. Now, we also did a small exercise today with the bank's balance sheet. The CFOs are all financial guys. They deal with balance sheet, income statements, financial statements. So these statements probably some have relevance to this, but preparation of financial statements. So CFO states the biggest risk of the bank is credit risk. Now you need to identify, to understand, he's talking about one part of one type of risk. So in your answer, you need to actually go back to our slide where I have put. Now say, he says only the credit risk the highest risk. Now if you look at this slide, it is part of financial risk, and in that part also you have three other areas of credit, market and liquidity. So in the eyes of a risk manager, you don't think it's the biggest risk, but your CFO says the biggest risk of the bank is the credit risk. Now you are supposed to critically evaluate this statement. So in your answer, if you have given me the type of risk of the bank are these, and if you have put this slide, I have given you that particular question had 8, I have given you 4 marks straight away without any evaluation. That means I will come to understand that you understand the type of risks. So today's lessons, one of the important is to identify and to know the type of risk a bank encounters. So remember, it is financial risk, operational risk, strategic risk, and regulatory risk are the 4 main areas. In the financial risk, you have credit, market, and liquidity. Now the CFO says credit risk is the largest risk for a bank. Now you are supposed to critically evaluate. To support that, I gave you a small exercise. You have a piece of paper with you. So that is the balance sheet of the bank. Now, in that balance sheet, we computed your total assets is 100 billion, your total liabilities are 100 billion. Now then, we said total current assets stands at 90 billion, fixed assets 10 billion, so that works out to 100 billion. Then we took another step. We went into analyze the current assets, and in the current assets, someone says cash, near cash, they say loans and advances. Very good. So you have understood your balance sheet proper. Now in that, we gave certain valuations to each item. Out of that 90, we gave 7 for your cash holding. We gave 14 for your investment holding. Then we gave 69 for your loans and advances. So out of 100, your loans and advances are 69. So CFO is thinking in the financial terms, credit risk comes from the total outstanding in the loans and advances. So he is right, because that is the biggest balance sheet item. Credit is the biggest balance sheet item. So managing credit risk is important for his thinking, because he thinks bank can lose a lot of money if you don't manage credit risk. So if you put that saying that CFO's idea of having the balance sheet and the largest item in the balance sheet is credit risk, so his statement in financial terms is right. So you have to say, but however, you need to evaluate banks as other risks. Banks encounter other risks like market risk. So we can lose credit you give to customers. All the customers are not going to default. Be part of it. You take investment and investment fails, you are going to lose money. If you have a liquidity problem, sometimes you lose the license. So that's a bigger killer than credit. So you need to mention few of those and say that credit is important in the terms of balance sheet. But however, banks also need to manage other type of risk to have a proper risk management process. If you answer that way, you have immediately earned 8 points. So probably what I have learned you will give you some kind of knowledge to answer part of a question in your question paper. So at the end of this session, actually, I am going to do some past papers for your understanding. But while doing it, I will, if I remember the questions, but I have already placed for the last 6-7 years, which I am doing the same subjects for this particular postgraduate program. So I will come that, and then we'll use that question for you to have a better understanding. So I think today we have covered, because if I do this with people's presence, I get interaction, and then it might run for 4 hours, even more, the interaction. Today we have managed with about almost about 4 hours. So for today, I am going to conclude with this. And remember the homework which I gave you. You have to go to the central bank website, go to the directions for licensed commercial banks, and please download the direction number 7 of 2011. And I don't want you to read this. At least if you download and keep it for your future reference, that is good enough for today's homework. So with that, I give you a little time. You can unmute your mic and ask any questions, or you can use, like what Mohan Guru Singh said, send me a question. Similarly, you can post some of the questions so that if time available, I will answer. If not, we will start answering those questions at the beginning of the next session next Sunday. So it's time for you. to ask me any questions. Please unmute and ask. I will wait 5 minutes because I know most of the bankers are very silent. They don't post questions. Actually, the finding about the subject matter, it's better to have a better interaction. So posing questions will enable that interaction, and it will be good for you as well as good for me. Then I will also be in touch with the subject matter regularly. Any questions? Since there's no question, so I will thank you all who are present today. I think there's about 59 of them participated. If you have questions, you can actually send me a note for answer in writing. So we'll meet next week. Thank you for listening, and hope you will do the homework which I have allocated to you. Thank you very much.